Okay, this is going to be the last video on the deep dive into serial acquirers by REQ Capital. I'll have a link in the description for this. You really should go through this if you're into serial acquirers. Today, I'm going to focus on something that we all forget as investors is that earnings per share drives stock returns. So this graph here on the screen, you can see that there's a strong correlation between total shareholder returns and earnings per share growth for the serial acquirers. And even though earnings per share is the primary driver of long-term share price performance, it is essential that earnings per share reflects free cash flow per share as much as possible. And this graph on the screen shows a select group of serial acquirers where earnings per share and free cash flow growth are correlated. I think this is really easy to forget in investing is that earnings per share and free cash flow per share, if that's growing, so are going to be the stock returns. And we often get distracted with all the other little things that are going on. But if we can just focus down on some of these really simple things and don't forget them, we should have no trouble holding the investments that we make. So here's two good examples with Lifco and InduTrade, where you can see that earnings per share is the main long-term growth driver. The red line is the stock returns, like the stock price, and earnings per share is the line underneath it. And then sales is that blue section underneath that. So over time, yeah, there's some volatility in the stock price, but it seems to move with earnings per share, as you can see. Now, this example of Vitec, I think, shows still the same thing, whereas earnings per share is increasing over time. The stock price is growing as well, but you can also see that margin expansion has played a big role in this too, for Vitec in particular, where they're getting rewarded by the long ability to generate earnings growth with these high returns on capital and being able to maintain that over a long period of time. That's where they're getting that margin expansion from as well. Now, I am being selective in picking out specific examples here because I'm going to show you Bravida now on the screen, where as you can see, as sales and earnings per share, well, earnings per share in particular, has dipped recently, the stock price has been punished because of the decline in earnings per share. And the great companies have been able to continue growing their earnings per share. Whether Bravida is able to turn this thing around, I'm not sure, but the stock price definitely follows earnings per share. Now for some international examples with Constellation Software, Roper, Danaher, and Heico. As you can see, earnings per share growth improving over time, share price improving with it. And then the margin expansion has been there to reward that long-term ability to generate good earnings per share. Danaher being a little bit interesting here as earnings per share has actually started to drop off a little bit, and the stock price has started to come back with it. So just the example is very clear that earnings per share and stock price are related, and we've got to keep remembering that. And I do my best with a select group of serial acquirers. Each week I put out valuations on these companies. I've got Constellation in there, Lifco's in there, Technion, there's a range of them. I keep track of them in yes stocks, no stocks. There's a link in the description. Like I said, it's weekly. I hope you enjoy it. Yeah, it's free as well. And just a reminder of why I like serial acquirers. Here's the long-term share price performance out of the Nordic serial acquirers. As you can see, it is significantly outperformed Berkshire Hathaway, the indexes, and they've been able to demonstrate this now for, 20 years, and I think it's going to continue into the future. And it's also not just isolated to the Nordic countries. If we look at a global portfolio of serial acquirers, we've got a significant outperformance against Berkshire Hathaway and the indexes as well. So good serial acquirers, even if you can get 15, 20 of them together, have shown that they can significantly outperform. The question is, which ones are you going to put into that group of the good serial acquirers? So there's a little bit of bias in here because we're picking at the best companies, and it's hard to know in 20 years' time what are the best serial acquirers going to be, but that's our job, and that's why we're studying serial acquirers. So there's so much more in REQ Capital's report. I'm actually only about 2/3 of the way through it. Some of the areas that are still to be explored, and I highly recommend just doing this yourself, is how important is organic growth to serial acquirers? What's the capital allocation strategies of serial acquirers? Dividend policies, the attitudes towards debt, using stock to pay for acquisitions, valuations, and red flags for serial acquirers. These are some really important topics that if you're going to get involved in this world, you really got to get your head around. So There's a lot more to it. Link in description for it. Link in description for Yes Stocks, No Stocks, my newsletter. Link in description for Interactive Brokers, which is the stockbroker that I use as well. Yeah, hope you've enjoyed the little series I've put together, and something that I'm working on into the future now, and it's going to be a bit of a change in direction of my channel, is that I am slowly going to start putting out more content on making an acquisition in the private market space, potentially with the idea of having my own serial acquirer in the future. But it starts with the first acquisition. Buying a company is full of a million risks, and I think I'm going to start putting out a lot more content around making a small private company acquisition, because that's what I'm going to do personally. And I hope you find it interesting to follow along with that little journey. Anyway, I'll see you in the next video.